In today's video, I'm going to explain to you the number one reason why retirees run out of money. You see, it's not bad returns, it's bad timing. And I'm going to show you in this video exactly how to remove timing from the equation so that you can retire with full confidence knowing that your money is going to last you your entire retirement. I'm Rahul Shah. I'm the CEO of Doc Shah Financial. We are a wealth management practice that helps retirees and pre-retirees save a lot on taxes and also make sure that their portfolio fires on all cylinders. The slides you're about to see are directly from the retirement planning class I teach at Johns Hopkins University, which is also my alma mater. Now, why is it that bad timing, more so than bad returns, affects the length and success of your retirement? What boils down to one risk, and that risk is known as sequence of returns risk. Sequence of returns risk boils down to the danger that you have a bad market year in the year that you retire, right? That's that bad timing element to it. Because if you retire in a year that the market crashes, well, your entire retirement is now starting from a much lower base. So the way to think about this is in an extreme. If you went into retirement with, let's say, $1 million and the market crashes by 30%, a huge bear market in the year that you retire, well, now all of a sudden, you're starting retirement with $700,000. And as you're withdrawing money to live, you're actually compounding your losses. Because let's say you pull out $50,000 to live, well, now your portfolio is at $650,000. That $50,000 took a huge chunk of your overall principal out. So the question we have to ask is, whatever we saved leading up to our retirement, how do we protect that capital and make sure that it lasts us the entire duration of our retirement? And I'm going to show you how in this video. But first, I'm going to use an example between two retirees. So let's take the example here between Blanche and Brenda. Now we're going to make a few assumptions here just to keep the example really simple. We're going to assume that both of these women retire with $2 million in their portfolio. We're also going to assume that they require $80,000 a year to live. We just took a standard 4% withdrawal rate just for this example. We're also going to assume there's no inflation or social security or taxes or any other, investment returns that would complicate the concept of what I'm about to show you. We're just going to take two individuals, Blanche and Brenda. They both start with $2 million in their portfolio. Now let's say that the year both of them retire, there is a huge market crash and both of their portfolios decline. Let's say Blanche's entire portfolio was invested in stocks. She just owned the S&P 500. The S&P 500 has crashed. It's down 20%. Her $2 million portfolio is now at a $1.6 million market value. Brenda had a more diversified portfolio. She didn't have all her monies in stocks, and so even though the market was down 20%, because her portfolio was diversified, she had a war chest, she owned bonds or other fixed income assets, her portfolio was only down 5%, despite the overall market being down 20%. Now, if we look at these two, we've got Blanche, who's down to $1.6 million, who is now also going to withdraw $80,000 from her portfolio. We've got Brenda, whose portfolio is only down 5%, and she as well will withdraw $80,000 from her portfolio. What are their individual portfolio balances now 1 year into retirement? Well, we can see here that Blanche's portfolio is worth $1.52 million, and Brenda's portfolio is worth $1.82 million. This is a very large difference. It's $300,000 of a difference just because of the way that their portfolios were set up. Blanche's was too risky. It was too aggressive. She shouldn't have entered into retirement with all of her money in stocks. That's what I talk about bad timing. If the market didn't go anywhere and their portfolios remained at $2 million each, well then there wouldn't really be any cause for concern. But remember, there's a lot of risk because there's volatility in the market when you enter in retirement. When you're younger, volatility is your best friend. You actually want that to help you make better long-term returns. But in retirement, we don't want to have a portfolio that's very volatile because we run into sequence of returns risk. The risk that one bad year, one volatile year at the start of your retirement is going to dramatically shrink your portfolio, giving you a lower base to support the rest of your retirement, and that's what we want to avoid. So now that we understand the concept of sequence of returns risk, how do we actually go about solving that problem? But the first way to solve for this risk is asset allocation, right? We're looking at your whole portfolio and we're going to determine how much do we need to keep in a war chest, how much do we need to keep in safe, stable assets, so that even if the market crashes, we still have enough of a portfolio balance that's stable that we can pull off of and live off of, and let the rest, the equity portion that's currently down, give it time to recover. Let's say, for example, that we figure out we want to put 5 years of income needs away in our war chest. So $80,000 a year times 5 is $400,000. So we want to keep at least $400,000 in a war chest fixed income asset, something that's stable. And if we put the rest in equities, let's just say the S&P 500, well, now that market drawdown doesn't hurt as much, because even if the equities go down, A, it's not the whole portfolio, but B, Blanche in this case could live off of the fixed income assets in that war chest and give time for equities to rise. She's got 5 years worth of liquidity, and if individual retirees feel that's not enough, you can always make that more. You could put 8 years or you could put 10 years in your war chest, whatever you feel is appropriate for your plan and your standard of living. So that's how we use asset allocation in a very simple way. Of course, there's more nuance to this that I always discuss with clients, but that is the overall concept. And the bottom line is asset allocation is your primary defense against sequence of returns risk. Now, the second part of keeping your portfolio stable and preventing sequence of returns risk is diversification. We don't want to put all our eggs in one basket at any point in our life, but we certainly don't want to do that in retirement. When you're young, you can afford to be more aggressive. But when you're retired, you have to have a more balanced portfolio, a portfolio that is more diversified. Diversification means assets that aren't necessarily correlated with each other. That is the textbook definition of diversification. But even having diversification across asset classes, even if they are correlated, is still better than putting everything in one individual investment, right? So there's always degrees to this. At the end of the day, what we're trying to do is reduce the volatility of your portfolio. And so if we own different assets, we get the benefit of reducing that volatility and keeping your portfolio more stable so that we don't have those big market drops right when you retire. So that sequence of returns risk, that's asset allocation, and that is diversification. So there you guys have it. Sequence of returns risk, right? Having those really bad years at the start of your retirement can kill your portfolio. And we can fight that with two primary defense mechanisms: asset allocation and diversification. If you'd like to discuss your own portfolio and your personal situation with me, just shoot me an email, raul@dockshotfinancial.com. I love to manage client assets for retirees. It's a lot of fun. I enjoy the planning aspect of it. So I'd love to hear from you and your personal situation and how I can help. Until then, I hope you subscribe, and I'll see you in the next video.